Good afternoon. My name is Rebecca Spence, press officer at the Bank of Canada, and I will be moderating this press conference. Governor Macklem will be pleased to take questions for 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you. We have a number of journalists participating remotely today, so we'll do one question in the room first, and then turn to the call to try and make sure every outlet gets a chance to ask a question. The governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier, je vous demanderai également d'utiliser le micro sans fil, libre à vous de poser vos questions dans la langue officielle de votre choix. So we shall go first to Mark.
Hi there, Mark Rendell with the Globe and Mail. Thanks for taking the question, Governor. Wanted to dial in on the part of your speech where you talked about how we need to be careful not to misdiagnose economic weakness. Monetary policy should not try to compensate for lost supply. And then, of course, lowering interest rates in the face of weak economic activity risks stoking future inflation. I'm wondering, that's a general comment about how you're thinking about monetary policy in this transitional period, but what does it mean for how you're thinking about monetary policy decision making right now? And is that statement meant to be a signal to markets that you're more concerned about upside inflation risks than downside growth risks?
We're clearly worried about risks on both sides. I think, why did I highlight that risk? There clearly, there's two kinds of mistakes you could make. If we thought the weakness was more structural, so more, the capacity is not there, when in fact it is more cyclical, what that means is, we'd make the mistake of not providing enough monetary policy stimulus, and inflation would come in, economy be weaker than it needed to be, and inflation would be presumably below our target. The other risk, which I highlighted, is that the economy is weak. We interpret that as largely cyclical, when in fact more of it is structural. And so we lower rates too much, and inflation goes up. So why did I focus on the second one? Well, the reason I focused on the second one is that, historically, most of the cycles they're more demand driven. They're more, movements tend to be more driven by cyclical weakness. And so when you see GDP is weak, your sort of natural reaction is, oh, the economy's weak, it needs stimulus. Right now, though, we are in a period of this convergence of structural breaks. There is an unusually rapid amount of structural change. And so that is something we need to be focused on, and we need to do our best to sort of parse out how much of this is structural and how much of this is cyclical. And if you look at our outlook, part of the weakness is cyclical, part of the weakness is structural. If we thought it was all cyclical, yeah, we'd probably be in a position to provide more monetary policy stimulus. But the fact that some of it is structural means that if we lower rates too much, that will stoke inflation down the road.
All right, we'll go to the call now. I just want to remind people on the call to mute their line if they're not asking a question. We'll start with Greg Quinn from Market News, followed by Barbara Schechter of the Financial Post, and then Craig Lord of the Canadian Press. So go ahead, Greg.
Good afternoon. One global change we've seen over time is the rise of China, and concern G7 leaders have expressed about its overcapacity and export practices. Is this another one to put on the list you've laid out already? And in a wider sense, would the lives of Canadians be easier if China reined in its policy of export-led growth?
You're right, Greg. I focused on three. I focused on those three because I think they are the most prominent for Canada. Obviously, historically anyways, 75% of our trade was with the United States. It's now in the high 60s because our exports to the United States are down quite markedly. But you're right. There are other global developments that will impact Canada, and beyond the U.S. swerve to protectionism, and even before President Trump, or at least President Trump's second term as president, we have been seeing increasing fragmentation in global trade, and as you pointed out, one element of that is China has is increasingly trading with other countries, non-U.S. They've done actually quite a good job of diversifying away from the U.S. to other Asian economies, to some extent to Europe. So yeah, that is shifting global trade. And yes, there is a concern that the large Chinese trade surplus is unsustainable. This isn't something that needs to get fixed overnight, but what we've seen over history is that when you get large, unsustainable current account imbalances, those tend to feed, or they can feed, financial stability problems, other problems in your economy. So what you want to see is the international monetary system adjust. You want to see exchange rates adjust so that these imbalances gradually work themselves over time. What you don't want to see, but if that adjustment doesn't happen, they tend to build up, accumulate, and then there's a danger that something breaks, and we've got a whole new problem to deal with.
We'll go to Barbara.
Hi, you spoke in your speech about how Canadian businesses should be looking to increase their exports to partners other than the United States and to AI, but you talked about how it's been a year and things are moving, it seems to be pretty slowly. So my question is, is that, given that it's been, close to a year, is there reason to expect that, or is it suggestive that this is a really difficult thing that isn't going to happen, that there's in a sense of we can't sort of keep up or do this quickly enough? Is that a concern?
Well, just to clarify my message, I think the way I'd put it is it's only been a year and we're already seeing a significant amount of adjustment. That's encouraging. The other part of the message, though, is that this is going to take years, and there is a long way to go. And structural headwinds, they're not temporary. These changes, they're not going to go away. Our trade relationship with the United States is fundamentally fractured. The population growth is lower. AI is coming. It is no doubt going to be a transformational technology. How transformational, how fast that happens, those things are uncertain. But the direction of travel is clear. And what that means for businesses is this isn't something they can just wait it out. They can't. This isn't about enduring it. It's got to be about embracing it. Structural change needs to be a catalyst to move forward, to invest in new technology, to develop new markets. From a policy perspective, it needs to be a catalyst to opening up our internal market, reducing interprovincial barriers to trade, growing our internal market, reducing, streamlining regulatory approvals so we can proceed. Businesses can get moving on investment more quickly. That's really the message. I actually, given that it's only been a year, and we are seeing adjustment, I think that is encouraging, but we really need to seize that momentum and build on it. That would be the message.
Thank you.
Craig Lord.
Thanks for taking our questions, Governor. Towards the end of your speech, you outlined a kind of dire scenario where the economy doesn't adapt and we see both affordability issues intensify, GDP and productivity growth stagnate. In that kind of an outcome where we fail to adapt to these structural changes, what does the Bank of Canada's monetary policy response look like?
Well, First of all, let me say that is not our base case. Our base case, the combination of government policies to help businesses pivot, help workers adjust, government incentives to increase investment, together with what we're hearing from businesses that they are looking for other markets. They are going more to Asia, more to Europe to try to develop those markets. Our base case is that restructuring does happen. It's and what that means is that we're not on as good a path, as high a path if we hadn't had increased trade friction with the United States, but we're on a much better path than if we don't adjust. So, there are things, AI, if we do get a productivity boom from AI, things could be better than we expect. But if we don't adjust, they will be worse than we expect. And I think the message is, that's what we really can't afford. If I was to sort of boil it down, is look, there's a lot of noise out there. It's a tough environment to take decisions in. But I don't think the noise is going away anytime soon. And when you look through the noise, these structural breaks are clear. And the best thing we can do is get on with dealing with those things. And the faster we do that, the more boldly we do that, it will take time to accumulate. But as those structural changes accumulate, our economy becomes more resilient. Our productivity growth starts to improve. Our economy, we're better able to deal with new shocks, and our underlying trend growth is stronger. It will take some time. It will involve some difficult adjustments. But if the alternative is not making those difficult adjustments, the ultimate outcome will be worse.
Okay, next on my list I have David Lundgren from Reuters, and then we'll go to Eric Hertzberg of Bloomberg, and then Max Sato of Mace News. Go ahead, David.
Hello, Governor. Thank you for doing this as ever. Kevin Walsh believes that lower interest rates can help accelerate the structural transition underway. Does the Bank of Canada not share that view?
Well, I'm going to let Kevin Walsh speak for Kevin Walsh. I think, what I will say is that artificial intelligence, I think, there is no doubt this is a transformative technology. Economists have this word, general purpose technology. So what does that mean? Well, it means that it's something that it can be applied very broadly in the economy, and has the potential to, enable whole new businesses. So, I do think, we expect, much like we saw from the internet, where we did see a productivity boom in the second half of the 1990s in Canada. It wasn't as big as the productivity boom that we saw in the United States, but it was very noticeable here in Canada. And what that meant in the second half of the 90s is that the economy grew faster and we didn't have increased inflationary pressures. That is the potential of AI, and I think that will materialize. But exactly when it will materialize, how quickly it'll materialize, that is a tougher question. And when we look at Canada, so far, if you look under the hood at individual companies or occupations, yes, you can see some impacts of AI. But if you look at the aggregate productivity numbers, if you look at the aggregate employment numbers, you don't yet see much of an impact from AI. When we talk to companies, what we hear is that most companies will say, yeah, sure, we're using AI, our workers are using AI. But then if you ask them, okay, have you implemented AI to sort of fundamentally change the delivery of operations, and is it having a clear impact on your bottom line? Something, StatsCan has surveys, we have surveys, it's something like in the range of 10% of companies say yes. So it's not too surprising that you don't see it yet in the data. They also tell us, though, that they've got plans going forward to ramp that up. So we'll see. But I guess from our perspectives, we can't count our chickens before they hatch. Let's hope that let's hope that productivity payoff is there. Let's hope the economy can grow faster without increased inflation. But we haven't built that yet into our forecast. If we start to see that, we'll adjust our forecast.
Go ahead, Eric.
Hey, Eric Hertzberg with Bloomberg News here. Good afternoon, Governor. The concept of underlying inflation, it featured pretty prominently in the October MPR and at the end of last year, but it was nowhere to be found in last week's communications or the MPR there. Why is that? And do you now have more faith in banks' preferred core measures now that they've started to ease?
Well, there's a very simple reason for that, Eric. Back when we were talking more about it, in practice, we look at a broad range of measures of core inflation. We've got our preferred measures, there's various alternative measures, we look at the distribution of price changes, and most of the time, our preferred measures of core give a kind of a good summary of what most of those the broader range of indicators are telling us. But going back a few months, we were in the situation where our preferred measures of core were running around 3, but when we looked at the broader range of indicators, they were all sort of suggesting something more like 2.5. So we did, I think we were just being very transparent with you. Look, yeah, our core measures are running around 3, but when we look at all the indicators, the weight of the evidence is suggesting it's something like more like 2.5. Well, what's happened in the last few months is that our preferred measures, of course, have come back down to about 2.5. So yeah, underlying inflation is 2.5. Our core measures are 2.5. There wasn't a need to draw a distinction. They're all running around 2.5. That's a simple reason.
Okay, we'll go to Max.
Thanks. Hi, Governor. Max Soto with Mason News here. What you discussed today applies to many major economies, I think, and not just Canada and the US, but others also have tight relationships from the economic, financial, and diplomatic viewpoints. But do you think Canada's own structure change could have a bigger impact on your monetary policy than similar change in other economies could have their own policy?
Well, look, you're right. These changes are not unique to Canada. Trade with the United States in many countries is going to be less going forward than it's been historically. In many countries, population growth is going down, and obviously AI is affecting companies all over the world. So these are not unique to Canada. I do think in the case of Canada, at least for the first two, the structural breaks are particularly important. Canada is a very open economy. We are very concentrated in our trade, with 75% of our trade with one country, the United States. And the nature of trade between Canada and the United States is also different from many other countries. If you're in Asia, you're in Europe, you make stuff, you ship it to the United States, US makes stuff, they ship it to you. The nature in Canada, though, Canada and the United States, we make stuff together. We've had an integrated business model where, a car or a piece of machinery, parts are made on both sides of the border. It comes together to make a final product. But effectively, that product has gone across the border multiple times. So, the increased trade friction with the United States, these steep tariffs on specific sectors, they are having a profound effect on the business model for these sectors. So the impact, even though the average tariff rate Canada faces is not that high, it's actually among the lowest, I think the impact on Canada of this fracturing of the trade relationship with the United States is particularly large. So in that sense, there is there is a clear structural break for Canada. On our population, I mean, our population growth actually historically has been higher than many other advanced countries. And we, the combination of lower fertility rates and now lower immigration rates means that we've seen, fairly marked deceleration in our population growth. But, it had been, on average run around, it's contributed about 1.5%, almost 1.5% on average to underlying trend growth. That's going down close to, is barely positive for the next few years. So that's a big change for Canada. So yes, I do think these are not unique to Canada, but I think at least for those two, I think Canada, it's a particularly prominent change.
Okay, we'll wrap up with Paul Vieira of the Wall Street Journal. Go ahead, Paul.
Paul, I'm afraid we can't hear you.
Hello.
Oh, that's better. I hear something.
Okay. Governor, do you think Canadians or Canadian businesses are too slow in adopting AI?
Well, let me answer that in two parts. First of all, there's a whole range of experience. Some Canadian businesses are full on, deeply into the adoption of AI. Others are moving more slowly. I think it's hard to know right now based on the data we have, but I will say as a general comment, yes, Canadian businesses have not been investing as much and as quickly in new technologies as their American competitors. And that has hurt our competitive position. In the case of AI, what's interesting is that on the sort of intellectual foundations, on the innovation, Canada is world leader. We have some of the leading computer scientists, leading engineers in the development of AI. We haven't been as fast in adopting AI, and the real payoff for the economy, the broad economy, is the adoption of AI, and the use of AI to augment the productivity of workers, and allow for new business models. That's where you get the big payoff. So, yes, I think it's hard to get an immediately good snapshot of exactly where Canadian businesses are, but the message is, historically, Canadian businesses have been cautious. This is a time to be bold. This is a structural change. Waiting for it to go away is not going to work. The faster you move, the more competitive you're going to be.
And that's all the time we have for. So thank you very much to the governor and to all for participating. Merci.